For a lot of us, when we start investing passively in syndications, oftentimes you're investing in a deal not because of the merits of the deal per se, right? That's a very human thing to do. It's true for all of us. You're investing with either someone you know, like, and trust, right? And sometimes that's physicians because you have that bond, right? You have that trust factor. Or sometimes it's because you see your friend invest with someone who has a specific strategy and they've done really well, which is true for most people who exited syndications in the last 3 years. And you're looking at, your friend who doubled his money in 18 months, IRR is above 30%, and you're like, that sounds like a great strategy. Honestly, I think the safer thing to do is to really build your own buy box, because one size doesn't fit all. That's what I keep talking about over and over again. And when you are investing with someone you know, like, or trust, or following someone else's strategy, you end up overcomplicating, sometimes diversifying your portfolio, and most importantly, you end up with a real estate portfolio that isn't aligned with your overall goal. Welcome to Generational Wealth MD's podcast on financial freedom through investing in real estate. My name is Param Baladandapani. I'm a mom, radiologist, real estate investor, and mentor to others looking to start or scale their real estate portfolios. Thank you for being here today. The goal of this podcast is to provide you with inspiration, strategies, and insight so that you can stop trading your time for money and live life on your terms. If you love the episode, don't forget to subscribe and leave a review. So what we're going to talk about today is essentially step one for any of you thinking about investing passively in real estate syndications, right? This is what you're doing before you're learning to vet the deal, vet the sponsor, vet the market. This is what you do before all of that. This is before you create a due diligence checklist that you're using. And what I noticed is that oftentimes although this is the most critical step, in my opinion, this is the most overlooked step. So I'm super excited to deep dive into it. I like breaking it down. So basically broke it down into 4 essential questions that you should be asking yourself to help you build your buy box for investing passively in syndications. And that's going to be your guide, right? That's going to be step 1. So let's deep dive into it. Okay, now last week, I talked about how excited I get about the end of the year. I usually, like, the last quarter, the last month, I have very specific goals. I'm trying to hit those targets. It's a great time because you have defined timelines. Even for people within our coaching program, I find that those who are in the fall cohort, they really take massive action rapidly because they have a deadline. They want to get their short-term rentals listed and placed in service before the end of the year. And so there's a lot of momentum. So there's a lot of momentum for me personally, professionally, fitness goals, whatever it is. But we talked last week about 5 strategies that you can use before the end of the year to really help you save on taxes. And I think there was a lot of interest for strategy number 5, which is the advanced tax strategies, which includes short-term rentals, reps, real estate professional status. But for most of you, that doesn't really apply to you. The one thing we talked about, where if you don't own a business, if you don't own real estate, if you're a W-2 employee, you can still take advantage of 80% bonus depreciation. This is the last year to do it when you're investing passively in real estate syndications, right? So that's something that applies to a lot of you. And in all honesty, that is also the strategy that I'm going to be using in the next 30 days. It's a tax strategy I'm going to focus on to help me save on taxes. And that is the 80% bonus depreciation when you invest passively in real estate syndications. I invest my own capital in my personal name into every deal that we go into every deal that GW Capital is in, and I'm investing my own capital into Stewart's Mill, which is the deal we currently have that's going to close next week. When I do that, I will be tapping into 80% bonus depreciation, and Stewart's Mill is already oversubscribed. We have all the funds we need to close. All we're doing right now is raising additional cash reserves, which is something we do to really make the deal safer, and it's a more conservative strategy right now. So that's all we have. The smallest amount available at this point. So anyone interested, make sure you're submitting your soft commit and getting in touch with us, booking a call with us as soon as possible. But I've had conversations with so many of you in the last week since we did the last podcast. And for some of you, it was your first connection with me. And what I like to do on our first call is always help you do this, right? Help you build your buy box. And so I've been going through the process multiple times, and I realized that it would be great to do a specific episode just about building your buy box, because this, like I said, this is in my opinion, the most crucial step, but also the most overlooked step. And so I usually ask you 4 questions, and I've done this so many times. I realize that it's essentially just those 4 questions, which helps me identify which box you fit into and how you should be building your own buy box. That's what we're going to talk about. This is also covered extensively in our free due diligence checklist for passive investors. So if you haven't had a chance to download that, go ahead and take a look at it. It's generationalwealthmd.com/guide in lowercase. The guide doesn't just go through step 1, it also goes through vetting. How do you vet the deal, the market, the sponsor? How do you, come up with a due diligence checklist, which is just 10 to 15 questions that you're going to be asking every time you try to look at a deal and see if it makes sense for you. So that's more comprehensive. We're going to go into step 1 over here today. But for those of you who are still interested in trying to tap into 80% bonus depreciation, take advantage of that before the end of the year. generationalwealthmd.com/Atlanta3. We are closing next week. So please make sure if you are interested, we have very, very limited spacing, to reach out to us quickly. But the reason I'm doing this is because, and the reason we built out the guide, which is a free resource for the community, is because what I noticed when I was talking to so many of you is that for a lot of us, when we start investing passively in syndications, oftentimes you're investing in a deal not because of the merits of the deal per se, right? That's a very human thing to do. It's true for all of us. You're investing with either someone you know, like, and trust, right? And sometimes that's physicians, because you have that bond, right? You have that trust factor. Or sometimes it's because you see your friend invest with someone who has a specific strategy and they've done really well, which is true for most people who exited syndications in the last 3 years. And you're looking at, your friend who doubled his money in 18 months, IRR is above 30%, and you're like, that sounds like a great strategy. Honestly, I think the safer thing to do is to really build your own buy box, because one size doesn't fit all. That's what I keep talking about over and over again. And when you are investing with someone you know, like, or trust, or following someone else's strategy, you end up overcomplicating, sometimes over diversifying your portfolio. And most importantly, you end up with a real estate portfolio that isn't aligned with your overall goals. So what we're going to do today is we'll deep dive into your why, right? Always start with why. If you've heard me talk about direct ownership of real estate, it boils down to the same question. So many of you come to me and say, Param, I want to invest in short-term rentals, or come to me and say, Param, I want to be a general partner in syndications. And this is true for friends, for members of the community. My first question is always, okay, tell me why. Why is this important to you? Why do you want to be a general partner? Why short-term rentals? And so the why is really important. And so we're going to start off with the why, and we go over the 4 questions you should be asking yourself to build that buy box. And then I want to talk about another important question that I get, how much should I be investing in my first deal? And because I would say 50% of our community, especially within GW Capital, you're investing, I would say 40% possibly at this time, because we have so many repeat investors are investing in syndications for the first time. I think that's an important question to address. So we'll go step by step, right? So the first question is always, why are you investing in real estate? First of all, right? Why? And the answer is going to be very different for each and every one of you. So we know that, and I talk about financial freedom, we talk about passive income. I'm not necessarily talking about retirement, but uncoupling your income from your efforts. For most of us, it's going to be from medicine, right? So you practice medicine because you want to, not because you need the income. So just uncoupling that, right? And the reason real estate is so powerful is because it's a combination of returns from cash flow, equity buildup over time, and tax efficiencies. Now, cash flow is something that's hitting your bank account every month. For some of you, that may be the most important thing. For some of you, it's going to be velocity of growth. So that equity buildup over time, that's going to be more powerful for you in the long run. That's what you're focusing on. And then there are going to be, well, this applies to most of us, but for some of us more than others, tax efficiencies are going to be really important, right? Really tapping in getting that tax-free income is going to be really important. For some of you, you may have other passive income sources. So bonus depreciation becomes super powerful because this year it's significantly lowering your income tax burden, right? Not just from distributions that you're getting, but also from your other passive income sources. So again, those 3 categories, the importance for each of those categories is going to be different for each and every one of us. We're going to deep dive more when we talk about the 4 questions you should be asking yourself. But I think the overarching theme is that, and I've run these numbers just to show you how powerful real estate can be in your portfolio. Knowing that for most of us starting out, 90% of our portfolio is in stocks and bonds, as opposed to ultra high net worth individuals who have close to 50% of their portfolio in alternative assets, right? Like real estate. Now, if you were to invest 4K a month, 4,000 a month, over and over again into a stock bond portfolio, it's going to take you 20 years to get to financial freedom, right? 4,000 at 4,000 a month. If you're investing passively in real estate syndications, that number goes down to 8 years. And that's pretty impactful, right? And that's why most of us are investing in real estate. But even given that, the significance we place on cash flow, equity buildup, which happens over time, right, which is not immediate, and tax efficiencies is going to be different for each and every one of us. So that's the first thing, right? Why is this important to me? Which of those components is really important for me? And that kind of flows into the next part of this episode, which is what are the 4 questions you should be asking yourself to really understand what your needs are and to help you build your buy box? Because even within, so we talk about the spectrum all the time of real estate investing, which starts with passive, going all the way to super active with short-term rentals. But even within the spectrum of investing in passive real estate, there's a spectrum even over there, right? And so asking yourself these 4 questions really helps you identify where you are on that spectrum. Okay, so first question is going to be, what's important for me? Cash flow today, right? Or velocity of growth of my capital. What's important to me? So that almost ties into what we talked about before. Am I investing for cash flow predominantly, or am I investing to see my money double more quickly? What's more important to me? And that's going to put you in a different category, because when you're investing for cash flow, you may be investing in Class A shares even within the Stewart's Mill in investment that we have. It's what we call a value add strategy, right? So it's a middle ground essentially in terms of equity buildup and cash flow. It's middle. It's not super high in terms of equity buildup, and it's not super high in terms of cash flow, but it has a good combination of both. But even within that, you have different class shares. So we have Class A shares where our investors are getting close to 10% just from cash flow every year, but you don't get any upside in the equity buildup, which is what you realize when you sell the property, right? And then you have Class B shares where you're still getting about 5% cash flow from day one, which keeps building up as we execute the business plan, going from 5 to 7 and possibly even higher over the hold period just from cash flow, which hits your bank account every month. But you're also getting part of the profit at sale, the equity buildup, right? That profit at sale. And so that's velocity of growth. And so you get to pick and choose, but even within an individual asset. But then you have the other spectrum, which is a larger spectrum, where you have core assets. And so you'll hear me say this over and over again, but even within the passive real estate spectrum, you have on one hand you have opportunistic deals, right? Ground up developments. That's where you have higher returns. And then you have core assets on the opposite end of the spectrum, which is where you buy newer assets that are heavy in cash flow. There's no plan to go and rehab it and increase the value and really get that equity build up over time. It's more about the cash flow, right? And that's a lower return game, but it's also lower risk, right? And then smack in the middle, you have your value add deals where we're going in, we're doing a rehab from day one, we have cash flow coming in, right? Unlike your development deals where you're not going to see cash flow at least for the first 2 years because the plan is being executed. And so with the value add deals, you're seeing cash flow, but then there's also the strategy where we're going in, rehabbing and building up equity, so you get that boost when we go and sell, right, in terms of your ROI. So there's a spectrum, and you get to pick and choose between in both of these cases, right? Which kind of asset really makes sense for me? If you are someone who values cash flow, it's possibly going to be your core asset, right? That's throwing out higher cash flow. If you're interested in velocity of growth, you may be looking at more opportunistic deals like development deals, right? And even within an individual deal, you may want to invest in Class A shares if you're thinking about cash flow, or Class B when you're thinking velocity of growth. So that's the first question, right? What are my goals? What is important to me? And again, this is true for almost everything in life, right? This is not a rigid spot that you claim to hold for the rest of your life. It's very fluid. It's going to keep shifting, but you need to know where you are today so you can make decisions today based on that, right? Now, the second question, so you talked about your goals, right? Cash flow, velocity of growth, what is important? That helps you pick and choose the kind of deal you're going into. Second question is going to be the risk reward spectrum. Where do you find yourself on the risk reward spectrum? So again, when we're talking about the risk reward spectrum, I look at it in 3 different categories, right? So let's see. The first one's always going to be that spectrum where we described core assets, on the one hand, and your higher risk development deals, your higher return, higher risk development deals on the other hand, and then the value add deals smack in the middle. On that spectrum, again, it's a return spectrum, but it's also a risk spectrum, right? Because your core assets, which are your newer builds, which are throwing out cash flow, but you really don't have that, equity buildup happening over time because you're not really going and rehabbing the property, right? They're also lower risk. They're lower return. The returns typically around 10% average annualized returns, right? But it's also lower risk. So it's lower risk, lower return. And then you have your opportunistic ground up development deals where you have returns in excess of 20% average annualized returns. So, but they're also higher risk, right? Because there are more variables in there. And then smack in the middle, you have your value add deals, which again, those numbers fluctuate depending on the market cycle we're in. But on average, across market cycles, that's about a 20% average annualized return. In other words, your money capital doubled in about 5 years, right? That's where you tend to be in the value add space. And that's calculated risk with moderate returns, right? That's still significantly higher than what you're seeing in the stock market. That's what adds momentum to your portfolio. But that's a spectrum, and it's a reward spectrum. It's also risk reward spectrum, right? So that's what you need to identify where you are on that. The second thing is going to be like what we said, Class A and Class B shares. Again, that's a return thing, but there's also it also ties into risk. And so you decide where you want to be based on your risk appetite, and I'll tell you why. It's because of where you are in the capital stack. So your Class A, any investor holds Class A shares, they get that fixed return going into their bank account every month coming from cash flow. But they're also the investors who get paid out first, right? So Class B returns can fluctuate over time, depending on cash flow. But Class A investors get paid out before Class B investors, so there's lower risk over there. So it's a lower return, lower risk. Again, so you want to know what makes more sense for you, Class A or Class B. Right now, again, although it's just A and B, we have a lot of investors who want to tap into both of those things. They want to get higher cash flow and also have be part of the upside, right? Participate in it. And so they do what we call a blended return, which means they have, say, allocate 25% to Class A, 75% to Class B, or do a 50-50. Their money goes into both Class A and Class B, and they get to kind of stay in the center and benefit from both. That's an option also. But you really want to think about that, right? From a risk perspective as well as a reward perspective, right? If you're interested in learning how to invest in long-term and short-term rentals the right way, so you can accelerate to financial independence with the support of mentorship, community, and vetted investor agents in strong markets across the country, then get on the waitlist for the next cohort of Creating Generational Freedom at www.generationalwealthmd.com. You don't have to learn from decades of costly mistakes by yourself. The program is only open for enrollment in the spring and fall each year. In the last 6 months alone, our members have acquired over $60 million of real estate, and more importantly, they're living life and practicing medicine on their terms. You don't have to do it alone. We talked about 2 spectrums so far as the risk-reward spectrum goes, but I would encourage you to think about a third thing when you're thinking about your risk appetite. Now, every deal you go into, there is a property class. Now, it can be a little confusing because we said Class A, Class B, but there's also a property class, right? And that's a very subjective thing. When you look at a property, and you can ask your operators this, is this a Class A property or a Class C property? I'm not going to talk about Class D property because hopefully you're not investing or looking at Class D properties. A Class A property is something that's brand new, right? And it has the best amenities, the best tenant base, and so it's lower risk. It tends to be lower reward, but it's lower risk. Class C properties, on the other hand, tend to be older properties and typically blue-collar workers, right? But their returns tend to be a little higher, and so it's higher in terms of returns, but also higher in terms of risk, just because you may see delinquencies there. People may not pay, they may cause more damage to the property, more maintenance requests, right? So there's a spectrum even over there. And that's, again, part of the risk reward spectrum. And you need to identify where you are. So those are three subcategories within the risk reward spectrum, which I think it's important for you to identify. So you can say, I'm going to be investing in Class B properties, or I'm very risk averse. Class A properties make the most sense for me. Park 33, the last deal we were in, was a Class A property, brand new, 2018 built, and it was a core plus asset. It's actually between core and value add. Part of the Stewart's Mill deal we have right now is your classic stabilized value add deal, and it's a Class B property, right? So really identifying this helps you. Asking these questions when you build your buy box, being very clear about this really helps you go and assess a deal you're looking at before you even start looking at metrics or track record of the sponsors or the market demographics, right? So I think this is crucial, and this is very much like a broad overarching analysis that you need to do, and this is based on your goals and your where you stand in the risk reward spectrum, right? And so it's very unique to you, and it's very different from due diligence you do for the market, the sponsor, or the deal. Okay, so first two questions have been answered. Let's move on to question number 3, your hold period. So this depends on multiple things. It depends on how comfortable you're with being illiquid, right? So you have syndication deals where the business plan may be to hold the deal for 3 years, right? Shorter hold periods are typical for ground up developments. Even with the value add space that we talked about, the plan is always to, after the business plan is executed, which is end of year 2, typically around year 3, you're looking to see if we're always looking to see if we can exit the deal, right? If it makes sense from a numbers perspective. We underwrite for 5 years because in the event that the numbers don't make sense, we can't hit our projected returns. We want to be able to hold for longer till it actually makes sense to sell the asset, but we don't want our investors to start getting anxious, about the whole period. So we always underwrite for 5 years, but typically with a value add deal at the end of year 2, we're always looking to see what the best time for exit is, right? And those are shorter hold periods. Now, sometimes you have sponsors, and this is just their model. They may hold the plan, maybe to hold on to an asset for 10 years or 20 years, right? And that can happen. That's perfectly fine. That's where you have to think about what makes sense for you, right? So again, like I said, it's not about I like the sponsor. These are very important questions to be asking. These are based on your specific goals. What is the hold period? What is going to happen? Do I intend to work for the next 10 years? Will I require higher cash flow, or will I be investing differently 5 years from now? Do I have a child who's going to be going to college? Will I be using this money differently 5 years from now? Where do you stand? How liquid do you want your assets to be? What hold period makes the most sense for you? So part of it is going to be dependent on your financial situation, right? What makes the most sense for you, how your other assets are allocated. Second part of that, as far as the time frame, is also going to be based on returns, right? And the reason is because the longer you hold an asset, you're starting to mute returns. And that's because the highest value add, the ability to really have operational efficiencies and boost up your net operating income, which ultimately determines the value of your property in commercial real estate, is often the highest in the first 2 years when you're going in and stabilizing the asset, right? And so the longer you hold an asset, your returns start getting muted. And that may be perfectly fine for you if you're someone who's okay with your capital being in a deal for 10 years, 20 years. The lower returns may be perfectly acceptable to you. But that has to be an intentional decision. And that's all we're saying over here. So you think about your goals, right? What are you investing for? Is it cash flow or velocity of growth? What's more important to you? You think about where you stand in the risk reward spectrum. And we talked about 3 different ways of categorizing that and knowing exactly where you want to be in each of those cases. And then we're talking about the hold period that makes the most sense to you, right? And then the fourth question obviously is going to be, and this is something I ask all of you when we have our calls, do you have other sources of passive income? Some of you may have passive income from your investments in a surgical center that you're not active in, your share from a dialysis center, endoscopy center. So you're getting that hitting your bank account as passive income every year. Some of you may have a portfolio of short-term rentals that are now managed by a property manager. You're not materially participating in it anymore, and that is hitting your tax returns as passive income also, right? So you have other sources of passive income. Now, when you have other sources of passive income and you're tapping into 80% bonus depreciation, which you have if your deal closes before the end of the year, right? Now, 80% bonus depreciation affects all of us, right? For all of you, even if you don't have passive income, any distributions you get, which for some of our investors, like I have friends who have over $1 million invested in our deals, and they're throwing out, sometimes close to six figures in cash flow, which is tax free because of bonus depreciation, because those losses are used to offset, offset the income, the distributions that you get from your syndications, and you're essentially not paying taxes on it. And hopefully you're strategizing it where you're deferring having to pay taxes on it, right? So you're getting time value of money. So that applies to all of us, but especially for those of you with additional sources of passive income, you're immediately in the year that you acquire, you get those bonus depreciation losses from syndication investments, you're immediately able to tap into the tax savings. So your ROI essentially is significantly higher than what it is for other people, because if you get 40,000 or dollars in losses and you have $40,000 in passive income, then you're essentially not paying taxes on that $40,000 of passive income, which if you're in California, that's taxed as ordinary income, you'd be paying 20,000 in taxes. So, and that's based on your marginal tax bracket, right? So that's a significant savings right there. If you invested $100,000 in Stewart's Mill, you would get anywhere from $40,000 to $50,000 in passive losses on your 2023 returns because of 80% bonus depreciation. And in that scenario, you're getting a significant ROI in year one, right? So things to consider. So those are the four questions that I usually like to ask when we're having our first conversation. What are your goals like? What is important to you? Where do you stand on the risk reward spectrum? What time frame makes the most sense for you? And do you have other sources of passive income? Because then your ROI is calculated differently, right? That's it. Those are the four questions you're going to be asking yourself when you're building your buy box. And that's what you do before you even go down the whole path of, and hopefully you're looking at the guide and it simplifies things for you. Before you go down the path of, okay, how do I vet the deal? How do I, how do I come up with the due diligence checklist? All of that is in the guide, generationalwealthmd.com/guide. Make sure you take a look at it. But these are the questions you do before you go down that path. This is how you build your buy box. Okay. And essentially how I like to categorize our investors, even our passive investors, right? Even within that passive investment spectrum, is we have our safety seekers who, are perfectly fine. What makes sense for them is the low risk, lower return investments. And that's either because they are risk averse, it's because they're older. I have our investors who are bringing their parents in. We're typically looking at something that's lower risk, lower return. It could be Class A shares in our syndications. It could be core plus assets, right? And that's because of their age. It's because they're risk averse or because they're closer to retirement. It could be someone in their 30s and 40s who intends to retire within the next 4 or 5 years, right? Typically, if it's less than 2 years, then you need to start looking at deals that are throwing out more cash flow and are less risky, right? So that's the safety seeker. The second category is going to be who I call our planners. Planners are saying, I'm going to take calculated risks today because I want higher returns, right? And that's going to be someone who invests in value add deals and opts for Class B shares. And then finally, we have our entrepreneurs. Our entrepreneurs are younger, typically, or that's their risk aptitude. Their portfolio is such that it allows them to be a little more aggressive as far as their current real estate deals are concerned. And so they're in a position to take on higher risk for higher returns. Like I said before, this is not constant. It's very fluid and you can always keep shifting, but you are in a deal for at least 3 to 5 years. And so it's important to know, based on where you stand today, what kind of deal makes the most sense for you. Okay, perfect. Now that we're done with this, I want to quickly go over 5 questions. Okay, with a lot of you, when we have our first conversation, say, Param, I have $1 million. How much am I supposed to put into Stewart's Mill? And this is what I tell all of you, right? This is what I tell my friends. This is what I tell any of you who have a conversation with me. This is what I tell my family. There are 5 ways to be very logical about it, right? I'd love to say it's a solid deal. Just put as much as you can into it. I'd love to say that, but let's be a little scientific about this, right? What the first thing you're going to think about is your asset allocation. If you are 90% in stocks and bonds and you're trying to reallocate swiftly to have a larger amount in real estate, then you're going to be shifting more rapidly. If you're already 50-50 in terms of real estate and stocks and bonds, and 50-50 is where you want to be in terms of asset allocation, that is your goal, then you're going to be splitting your capital into both of those assets, right? So really know what asset allocation makes the most sense for you, where you want to be, and then how you split your investments is going to depend on how quickly you want to get towards that optimal asset allocation for you. So that's a broader thing that you're going to think about for your overall portfolio. The second question is going to be, how much are you saving annually? Are you going to have another $1 million to invest over the course of next year, right? If that is the case, then you would be ideally, you're probably going to go into 3 or 4 deals in a given year. And so that's something that, it's a decision you're making also. Are you going to go into 3 or 4 deals? Then you want to be splitting that up, right? And so it depends on how much you're saving annually. For some of you, all you're saving over the course of a year is $100,000. And so that's going to determine how much you're going to put into each deal, right? What your ideal asset allocation is, where you are today, and how quickly you want to shift that, how much you're saving annually. The next question is going to be diversification. How diversified do you want to be? Now, this answer is so different for everyone. I feel like the natural progression is where you start off wanting to be really diversified, right? If we have 2 active deals, sometimes our investors say, I want to do a little bit in both. I want to diversify. We have a lot of people who've been doing that. But what I notice is that over time, as you keep doing this, like a year from now, 2 years from now, you're going to be very, very clear about your criteria. And you can look at 2 deals and say, simplification of my portfolio is more important to me compared to diversification. And so I'm going to pick one. And that's just how I want to keep it. So that's a natural progression. You're going to start off with wanting a little more diversification and moving towards simplification. That's perfectly normal, right? So wherever you're on that spectrum. So diversification is another thing that is going to affect how much capital you're going to put into an individual deal. The fourth thing is going to be timing, right? Like right now, a lot of us are rushing to get in that last deal before the end of the year. So you're getting bonus depreciation. You're trapping 80% bonus depreciation before we lose that and we go into 60% bonus depreciation for 2024. If that is the case, then this would be a great time to get your capital into a deal which is closing before the end of the year, where you're still able to do 80% bonus depreciation like Stuart Mill, right? And so again, like I said, so many of our investors are getting close to 6 figures in just cash flow and distributions that are going out, and that is tax-free. The reason it's tax-free is because of bonus depreciation, and it's a nice way to lock in that 80% bonus depreciation when you can. So timing is another important consideration. And then the last one is going to be a better profit split. And so let me explain that. For those of you who know this is intuitive, right? Apart from Class A and Class B shares in each deal that we go into, we also have reserve class or Class C shares, which means if you bring in $500,000, and for some deals it's $1 million to hit reserve class. In Stuart Mill, it's $500,000, and so I believe $500,000 is typically the lowest. When you bring in $500,000 into the deal, you're able to get preferred returns, which means instead of getting on the back end the equity split, the cash flow you get is slightly higher. The profit split at the end, instead of our investors getting 70% of the profit and the operators getting 30%, you go from a 70-30 to an 80-20 split. So you're getting more enhanced returns, right? And so that may be a reason. So if you're considering putting 400,000 into a deal, but going up to 500 gets you into reserve class, then it may make sense to allocate higher just so that you're getting those enhanced split over there essentially. Okay, so those are the 5 things that I usually tell people to think about when you're trying to figure out how much you want invested in one individual deal. Okay, perfect. That kind of sums it up. Again, for those of you who are considering tapping into 80% bonus depreciation before the end of the year, generationalwealthmd.com/Atlanta3 is where you get information about Stuart Mill. There's a slide deck in there. There's a link to book a call if you want to have a conversation. I've had so many conversations with many of you. For anyone else interested or who's someone who's been considering and on the fence, if you want to know if it makes sense for you based on your buy box, on your criteria, feel free to book a call. We can have more conversations. But wrapping the whole thing up again, I think this part, like the 4 questions you ask to build your buy box, That is step one for anyone investing passively in real estate. And then you go on to vetting the market, the deal, and the sponsor, and having a due diligence checklist. The guide, generationalwealthmd.com/guide, has all of these things in it. It's a really quick read. I've heard that it takes about 45 minutes of focused reading to get through the whole thing, and it's full of graphs, and it puts all of this together that we've been talking about, really presents it easily. So if you're a visual learner, definitely download that. But I think, again, like I said, this is the time of year where you have the ability to really add momentum to your goals. It's what I'm doing, and hopefully this helps you when you're trying to make those decisions.